Hey everyone, this is Josh here with Invest with That. I hope you're doing well on this Friday afternoon, October 17th. We had a really wild market week this week with several intraday moves of 2 to 3%. Starting at the end of last week, it really carried through to this week. And we've seen a lot of pain, a lot of gain, and a lot of pain again. So, for those of you out there that are day trading, this is a really hard market to trade in just because it's going to chop you up on any given Trump tweet or news about China. As far as tariffs, we had the small banking concern because of loans with a couple of the regional banks that came out this week. I'm not overly concerned about that because I doubt it's systemic. Mainly geopolitical is what I would be mostly concerned with, although I'm also not really that concerned with that either. But today I wanted to cover TSSI because people always ask me about it because I was covering it back under $10 and it's done a lot of craziness since then, going as high as $32, pulling all the way back to 13, running back to 21. And right now it's kind of settling down with a 50% retracement into the $16 area between the recent high of 21 and the recent low of 13. I think it's a good time to talk about it just because, well, I feel like it's moving at the whim of the market. It was doing well while the market was doing well, and now it's pulling back because the market's pulled back. But it is a AI growth name, although it is not in the section of AI that really gets a super high multiple. So they're doing the data systems integrations and procurement for data centers. So think about the people that help you build out the data center. Very similar to SMCI, but at a much, much smaller scale. Although the charts do look similar, it had the run up kind of like SMCI did, pull back, and is now trying to recover. Although I think SMCI is just a little better positioned right now. So let's take a look at the chart, and it's not pretty, but it is what it is. And we'll add it to the stage. I'm putting my big hat out of the way. Um, Here we go. StreamYard is very laggy. So this is what it looks like right now. You kind of see the big run up. It pulled back, went up, retested highs, and then this huge gap was on the earnings last quarter. So for those of you that aren't familiar with what happened in Q2, they had a really good Q1 where they pretty much had 90, we'll just say $100 million in revenue. Their EPS was 0.11, and then giving the guidance that they had given for a fiscal year, a lot of people expected that to continue because, well, the AI trend has been really good. Unfortunately, it did not continue, as you can see here in the chart. They had a awful quarter in Q2. Well, I mean, it wasn't awful, but it wasn't very good. They only had a third of the revenue that they had in Q1. So the stock took a beating since then. Huge gap. I mean, honestly, just to fill the gap would be 28, which would be a pretty good return from where we're right now. I mean, it's like a 70% return just to fill this gap. But I haven't talked a lot about it because really wasn't much to say. The quarter was bad. They did guide up for second half of the fiscal year for 75% EBITDA. So we will use that in our calculations to try and extrapolate out what Q3 and Q4 could look like. We'll also think about Dell's recent upgrade to 7 to 9% annual revenue guide from the 3 to 4% that they had previously guided to Dell, who's the main partner of TSSI. Really, TSSI is just a arm of Dell, honestly. Almost everything they do and everything they get is for Dell, which is it's more of a bug than a feature, I think, personally. They really need to diversify. It's the difference between them and SMCI. SMCI has a lot of different customers. TSSI is almost exclusively working with Dell, which makes a lot of people nervous because if that revenue goes away, then they're kind of at the mercy of Dell right now. Which Dell is a major player in AI, so I don't think it's that big of a concern. But when you've only got one client, there's always the fear that hey, that goes away, you're kind of SOL. So, given Dell's guidance, given the guide up that TSSI gave on the earnings call, we try to factor in what we'll see in the two main segments for them, which is procurement Data systems integration. This is from the new Georgetown facility that they've expanded out. And I think last quarter was the first quarter where the majority of the facility was used for the entire quarter. I think this will be the first true quarter where the entire facility is up and operational for them. So, given the two factors that we talked about for Dell and for the 75% EBITDA guidance for TSSI, I'm looking at procurement to come in, and they did say Q3 because of government spending. Typically is their best quarter. I expect procurement to come around 80 million. Really, it could range anywhere from like 65 to 90 million. So to pick a midpoint here, what you would really like to see if you want to see a crazy move on earnings is procurement to come in at like 100 million. I think that happens, you will get a big move because that'll be much higher than expected. Data systems integration, I expect that to be 10 to 15 million. Again, that's another one depending on the capacity that they use. I expect them to use 100% of the capacity for this facility this quarter because they have a backlog at Dell. So somebody has to do this data systems integration work. And since they're one of their main partners, I would think that Dell would give them the bulk of the work because they are more or less dedicating themselves to Dell. The CEO was asked about potential partners on the earnings call. I think a lot of people didn't like this either. And his response was, if I distill it down to a very base level, um, hey, we're going to, and he doesn't say Dell, but he might as well say Dell. You say our main partner, we're going to stay more or less loyal to them. They will be our first priority, and we would only seek new partnerships if it didn't interfere with our current partnership with Dell. So unless it's a new segment or something outside of what they're doing now, they pretty much said we're not going to have another partner, which a lot of people were very sad about because you want to see a company expand. And it's really hard to do when you only have one person that you work for. So that's Q3 projection. I think Q4, because of the government spending, will come in a little bit lighter for procurement. I'm thinking around 75 million. Although I think data systems integration, as it continues to ramps, will come in a little bit higher, 15 to 20 million. So total revenues will be about the same for Q3 and Q4. I'm looking at around 100 million for both quarters. Now, keep this in mind, Q2 was 33 million. So the stock price that you're seeing right now is really reflective of that awful $33 million quarter. So if they can turn in like back-to-back $100 million revenue quarters and keep guidance strong for 2026, you're looking at a huge multiple compression for them in a AI sector that is, I think, should be solid for the next 5 or 6 years. And if it's not, then the whole market is in trouble. And it doesn't matter what you're in because AI is kind of holding everything up right now. Um, Even from a GDP perspective, like if you take out these AI effect companies, I think the projection was we would have had negative GDP in Q1 in the United States. So we need these companies to do well. So if you take both of those two, we'll say around 100 million for both quarters, and you add it to the 99 million to 33 million dollars in revenue they generated in Q1 and Q2. Now, that would put your PE around 38, which is not terrible for where they are as a growth company because you'd be looking at year-over-year growth for both of these quarters at like 100+%. So when you're trading at 38 PE and you're growing at 100% year-over-year, that's not bad. And you're in the AI sector, so you should get a premium because you're doing data center work. Price to sales would be even more interesting at this level. And I'm basing this off of the $16 price target, or not price target, but price that it traded at today. The market cap there is just a little over 400 million. So your price to sales for actual sales this year, if we get two back-to-back $100 million quarters, it would be 1.2. And that is a really small like price to sales for a growth company in AI. Typically, you see these companies trade at like 4x sales. So, it would almost be trading 1-to-1 in sales. So, if you really want to think something crazy happens, the market does have a bull run and AI narrative stays strong, then you would be looking at a 4x in share price, which right now, you know, what would that put us at? $64. Um, which I think it could happen, but you would have to have a lot of things go right. Uh, and I'm talking about this happening this year, like into the end of December. So we'll see. Those are my projections. So again, I'm looking at around 80 million per procurement both quarters. I'm looking around 15, 20 million on average for data systems integration. Facilities is there too, but you're only looking like $1 to $2 million for facilities. So it doesn't add a whole lot to the bottom line. Total revs, 100 million again. This would be in line with Q1 of this year and would make the Q2 result more of an outlier than something we would expect to see going forward in the sector that they are in. Um, the Dell upgrade or guidance increase where they doubled, that's a tailwind for them. Um, right now, it's not really priced to perfection based on that. I think the 75% EBITDA increase for the second half of the year was overlooked because of the comments that the CEO made about not having any new partnerships coming down the line. The other thing that really hit them after this sell-off was really right about here. They had started to kind of level out, but then they did a offering here 1750, I think is what they did an offering at, where they raised an additional $30 million in um, cash from the share offering and diluted the company. That was part of the reason why it got down to 13. I don't think we see 13 again. You could see 15, 14 if the market continues to sell off. But earnings really ramp up next week with Tesla and who else reports? Tesla and someone Netflix report next week. So if they come in and they're really strong for both of those, people will ignore the China stuff for the time being. I think they'll also ignore the regional banking stuff. It'll get thrown out with the bathwater, and it'll be all about earnings from that point going forward. And if they can turn in a really good earnings, they can do 100 million. That's 300% quarter over quarter, and I think it's like 150% year over year. So that would be hard to overlook. I think the headline alone, even though there's a bad taste in people's mouth because of the dilution, it was just really poorly timed. Like, why didn't they dilute up here at $30 instead of 17? I think it was just a misstep in a young company with a young CEO who hopefully learned from it. Um, so we'll see. Those are my predictions. Again, I think that would put it at around 341 million for the fiscal year in revenue, and that would put us around 16 million or so in net income. And I mean, they're a net income positive company um, with good growth in the Russell, and there aren't that many companies in the Russell. Honestly, they're top 5 percentile in the Russell, um, trading at sub 500 million. I think it's absurd. Company should be a $1 million company, and if it was, this would be trading back up here in the 30s. Or sorry, $1 billion company. It probably if multiples stretch, and we do have some sort of blow off top in December to the end of the year, and AI and earnings are strong for all the AI companies in Q3, and they give a good guide. Yeah, could we see 40 or 50? Sure, it's not that out of this world. I mean, if it can go from 30 to 13 in a few weeks, it can go from 16 to 40 in a few weeks. It's really not that different. Anyways, that's it for today. Those are my thoughts on TSSI. I'm still pretty bullish here. Everything should be set up. This is probably the last quarter I'm going to be in it. If they don't perform here with Q3, with Dell doubling their guidance and with the guidance that they gave, and with just the backdrop in AI, all these deals being made, all these companies working together, whether it's in energy, data systems integrations, the build out of the data centers, the AI companies themselves, like there's a lot of money coming in. And if they can't make big increases right now, they're never We're going to. So I'll see, this has kind of been my stance when people have asked. I'm like, I'm going to wait and see Q3. If they do what they should do in Q3, I'll stick with them and I'll continue, to take this ride. If they come in with like another $50 million quarter, I mean, it's or 50 or under. Honestly, if they do less than $70 million in revenue this quarter, I'm out. You just can't. You got to do better than that in this sector right now, as hot as it is. All right, well, that's it for today. Thanks everyone for watching. Y'all have a good weekend. Take care. See ya.